Canada's latest inflation data rose 2.2% on a year-over-year basis in November, matching the increase seen in October. Let's get more now from Dominique Lapointe, the Director of Macro Strategy with Manulife Investment Management. Dominique, thank you very much for joining us.
Good morning.
Your thoughts on the overall number first?
Yes, I think it's an okay print, Roger. 2.2%, just above target. It's the second consecutive months we are there. And it has a recap for 2025. We were for most of the time just below 2%, and now we're just a little bit above it. So the good news, important news, is that it's not running away from the target. So yes, overall, I think it's an okay print, and it's a sign of reprieve for people who would be concerned about inflationary pressures.
And any concerning numbers within it? I'm looking. Food month over month was up 0.2. Food was 0.9. CPI 0.2 month to month. Shelter was helping drop that down, but that's because the markets are kind of crashing. Any numbers concerning to you?
So food prices are always concerning. You've mentioned they were up 0.9%. It's actually like 5% year over year, and you have in there like beef prices around 30%. So it's always very concerning for that. However, that is not something that the government or even the Bank of Canada can control easily. StatsCan's mentioned, again, problems with climate change, with droughts, lower inventories. And at the same time, interestingly, this morning, StatsCan mentioned that U.S. tariffs on coffee are putting upward pressures on international prices for coffee, and that has indirect impact on Canada. So that's concerning, but that's not something we can control. And then, like you mentioned, we have other dynamics that are, I'd say, ingrained into the Canadian economy that continues. You have shelter prices continuing to see like lower inflation, and that's because mortgages are being renewed at a lower rates than last year. Home prices at the national levels are somewhat lower, so that's putting downward pressure on inflation too. And similarly, gasoline prices are still lower than a year ago. So all these items are somewhat pushing down inflation, and that's offset by some upward pressure on food prices, but also on other items like cellular phones that are somewhat more expensive than a year ago. So again, overall, I think it's an okay print, and that testifies that there isn't a lot of broad-based inflationary pressure.
And so what does this point to for the Bank of Canada moving forward now?
I think a big question coming into this report was if we were going to get a print that was somewhat too hot that would show that inflationary pressures are making a comeback. We've had some of those scares earlier in the year, which put into question if the Bank of Canada would be able to cut at all to support the economy. Then it turned out okay, and the Bank of Canada was able to focus on lower growth, on then what was the rising unemployment rate. And so the question this morning was, are we going to get somewhat of a hot print that would say we've cut too much, the economy is doing fine, we've saw the labor market rebounding, and so maybe we're going to need to hike next year. And I think with that print, it really relieves the pressure for the Bank of Canada to do any move at all. And we thought before the last decision that they were going to be on hold. We continue to think that for 2026, overall, they're going to be on hold. The focus will be on lower domestic growth, slower consumption, tariff uncertainty, making a comeback next year. And that's why inflation is not going to be the main concern, at least for the next couple of months.
And there was talk at one point that it would be either static for the Bank of Canada rate, or they might actually do an increase, possibly do an increase towards the end of the year in 2026. Does that look like that could still happen at all?
We can't exclude it completely, and many things can happen next year. However, if you look at what happened in terms of expecting that rate hike, it really came after the November labor force survey, which showed the unemployment rate in Canada dropping from 6.9% to 6.5%. And when we looked at the details, we found it's one of the only time in recent history when you had a shrinking labor force at the same time as you're creating jobs. Usually these two things go hand in hand. You're creating more jobs, you're bringing people back in the labor force. So it seems to us that those kinds of statistical, I'd say, anomalies are unlikely to be repeated, and that what we're really left with is an economy where we don't have many widespread layoff, but at the same time we're not creating a lot of jobs, and certainly not next year. So therefore, I think it's very premature for the market to anticipate a rate hike. And the Bank of Canada, their message last week was that they're not thinking about rate hikes right now. And we would really need to see bigger surprises on the consumption front, on the business investment front, so that they would think that they have to hike next year.
Okay, I just want to get a couple more questions before we go. Just going back for a second, we saw gasoline was down quite a bit. Any concerns that's going to bounce back, or what's driving that?
So, like you mentioned, gasoline inflation is down versus a year ago. And what we saw this year, to explain that, is there isn't a lot of global pickup in demand for oil. With the tariff uncertainty, with, I'd say, below average growth in the EU and in Japan, pretty much everywhere. There's a little bit of an imbalance between supply and demand, where we're adding a little bit of supply to oil, so that doesn't put upward pressure on oil, and therefore gas prices this year have been somewhat weak, which is a good news for the consumers. And for next year, our team doesn't expect also that gas prices are going to go up. Obviously, there's upside risk to that if we have geopolitical events unfolding. But the market doesn't seem to suggest we're going to get higher gas prices next year.
Okay, we've got about 40 seconds and we have to get out. But just quickly with tariffs, you mentioned it. How much of an impact do you see it being for next year?
In Canada, very little. We've removed most of the tariff on U.S. goods. There's still a little bit on that on cars. But now what we're seeing is that it's at the global level, where U.S. tariffs seem to have an indirect impact on global goods and therefore inflation in Canada, but I'd say it's very limited.
Okay, we'll wrap it there. Dominique, thanks as always for joining us.
Okay, thank you, Roger.
Dominique Lapointe is Director Macro Strategy at the Manulife Investment Management.